Okay, good afternoon, ladies and gentlemen. On behalf of your St James's Place partners, a warm welcome to this afternoon's client webinar. Wherever you may be joining us from, I hope you are keeping well and enjoying the summer. First of all, just to mention that today's session is being recorded. My name is Richard Nichols and I'm part of the team here at St James's Place Wealth Management, and it's my pleasure to host this afternoon's event, which I hope you will find both interesting and informative. Just a brief walkthrough of today's event. In a moment, I'll be handing over to our guest speakers, Tony Wickenden and Simon Martin. But before I do that, just a couple of points for your attention. Firstly, we have hopefully allowed enough time for some questions at the end of the presentations today. Now, a number of you have submitted questions in advance of today's session, so we'll try and answer a couple of those as well. If we're unable to answer all the questions you have submitted, we will make sure your St James's Place partner gets to see them, and no doubt they will be in touch post this event. If you'd like to ask a question during the event, you can submit any questions via the question box facility, which hopefully you can see in the control panel at the bottom of the screen. At the end of the event, we'll be asking you to complete some feedback. Now, we are genuinely interested in your views, so if it's at all possible, please take some time out to complete the feedback, which will come up automatically as the event is closed down. Now, because of the number of clients on this webinar, which at the last count was around 1,000, we have placed everyone on mute. So, as I mentioned, I'm delighted that we're being joined today by our two speakers. Just a bit of background on both speakers before I hand over. Our first speaker is Tony Wickenden. Tony is the founder and managing director of Technical Connections, which is a specialist tax and legal consultancy acquired by St James's Place just over 4 years ago. He has been in the business for 50 years and has written a weekly tax planning column in Money Marketing for over 35 of those 50 years. Tony is a Bachelor of Law, a chartered insurer, and a trusts and estate practitioner, and also a fellow of the Institute of Taxation. Our other speaker today is Simon Martin. Simon joined St James's Place in 2014, initially with our head office technical support team based in Cirencester. He's now moved on to become a regional technical connections manager for the Southwest and Central region. He is a chartered financial planner, a fellow of the Personal Finance Society, and his specialism is in providing financial advice and creating financial strategies for clients on all aspects of financial planning, including inheritance tax and trusts and estate advice. Simon is also a regular contributor to articles in the financial press. In terms of content for today, Tony is going to look in principle at some of the main tax and financial strategies that can be used to invest in, taking income and passing on wealth to improve intergenerational wealth. Simon will be looking in a little more detail at specific intergenerational financial planning strategies using cash, investments, and pensions. So I hope that meets with your expectations, and that's it for me for now. In terms of timings, we will aim to conclude around 5:30 p.m. So on that note, I'm delighted to hand over to our first speaker for today, Tony Wickenden. Tony, over to you.
Thank you very much, Richard, and good afternoon, everybody. It's a big subject, probably too big to cover in its entirety, and that isn't our intention. But hopefully you'll get at least something of value from what Simon and I are going to go through this afternoon. Great description that Richard's just given us as related to our aspirations for this afternoon. So let's get started. First of all, this is really important to say, I think, because this is our aim at St James's Place. It's basically, I won't go through the words, you can read them, to leave you better off with us than without us, basically. That's the key thing, to deliver, it's a phrase that's used quite a bit in this sector, which is advice alpha, basically the difference that a good financial planner makes to your financial well-being. And a key contributor to that, neat segue into the tax bit, is tax alpha. That is doing things taxed smartly so that you just keep more of your money, invest more of your money, and are able to then pass on more of your money because you've done the right thing with advice in relation to tax and tax planning. quick bit on the context, first of all. So where are we with tax? It's been in the news quite a bit, and it will continue to be, because there's a big part of that overall economic, well, malaise that we're in effect. So what part does tax have in that? So being tax savvy, knowing what's going on is really, really important to you, and certainly really, really important to your advisors. So I'm going to do a really quick retrospective on the 2021 tax changes, 2022 spring statement, and then the budget ahead. And all this is, I think, really important to making the most of the intergenerational tax planning opportunities that we have. So quick reminder, what we have is frozen allowances and thresholds from until the April 2026, so the end of the 25-26 tax year. And that doesn't seem like much at first. Well, nothing's really changing. And that's why the governments use this kind of way of getting taxed, because if you freeze things, no one feels terribly harmed, but over time, it makes a hell of a difference. It's estimated that this could generate at the end of that 5-year period on an annual basis around 40 billion a year. So that's quite big, don't you think? You know, given the government's aim to get money in, but not harm the economy. Corporation tax increases from April 2023. I could speak loads about all of these subjects, but happily for you, I'm not going to. And then we've got those national insurance increases, which we've all heard a lot about and are still with us and are likely to remain with us, changing its name, of course, in the not too distant future to the Health and Social Services Levy. And then we have the dividend tax increase as well. All of this is important, maybe in a small way when you look at those numbers, 1.25 doesn't seem that much, but it's really important to take account of everything that's going on to make sure that we are always in a position to make sure that you get the best outcome. There was nothing in the 27-10 budget of great note. And this is really important. It's not a subject I would in any way profess to be an expert on, but the economic context, and you will all be very well aware of this, isn't great at the moment for, you know, a number of very obvious reasons. We've got inflation, unbelievably, given how we've been over the last X number of years, heading towards 10%. That actually is a good thing from the government standpoint. It reduces the real value of government debt and materially increases the tax yield, basically, from frozen thresholds and allowances. Because if wages go up, as they are undeniably going to, then that means more tax is also generated. Growth, the really other important part to that dynamic of growth and inflation and debt, is sadly predicted to be on the way down. I mean, 0% growth for 2023, which puts us pretty much near the bottom of the table as far as OECD countries are concerned for next year. And then, as we said, inflation has an impact with higher interest rates on everything that we do. And that's something we just have to keep in mind and live with. What it does mean, though, is, I think this will be true for many of you, is it doesn't mean that doing things tax efficiently is no longer important and no longer relevant. It is clearly living and being able to afford everything that you need to live efficiently is so much more important. But for those that are fortunate enough to be in a position where you can do that and also be concerned about your investments and the return on them and what you're going to leave to your family, then it is perhaps even more important to pay attention to being tax efficient. So the spring statement basically just said, look, we're going to have a lower rate of income tax. There's been a lot of discussion around whether that's the right thing to do or the wrong thing to do. Not our position to comment on that, but it is going down the basic rate of tax to 19% from April 2024. You all knew that, but maybe had forgotten it because there's plenty of other things to be on your mind over the last few months. So where we are in relation to capital taxes is largely very good news, because there was some serious concern over the fact there might be some really big changes to capital gains tax, in particular linking it to income tax and therefore potentially doubling the rate of capital gains tax. That has been thrown off the table. I'm not sure if that's a good analogy, throwing it off the table, but it has. It's no longer on the table, should I say, because the OTS, the Office of Tax Simplification recommendations for reform, have been shelved very clearly and very obviously and very formally by the Chancellor. So where we are now, to remind you, with capital gains tax, is a few reminders, because this is important to the whole of capital, which is what we want to leave to the next generation. For UK resident domiciliaries, basically all gains on worldwide assets are potentially subject to tax. So if you've got a property abroad or an investment abroad, just because it's abroad doesn't mean you don't pay capital gains tax on it. Sorry if that sounds patronising, it's just a fact, and it's worth reminding you of that. There might also be tax in that country in which the property or investment is, but mostly that's ameliorated by what we call double tax agreements. 12,300 of gains each year are available to you tax-free, but you can't roll that forward. So it's on a use it or lose it basis. Gains from the sale of your main residence, thankfully, remain exempt. Gains, as I said, all of these subjects can be talked about in loads of detail, but gains are then taxed at 10% and 20%. And any of you who have second properties, buy-to-let properties, will know that it's 18 and 28% respectively for residential properties that aren't your main residence. Weirdly, strangely, I think, disposal by way of gift. So if you say, actually, I'm going to give you this thing, whatever it is, if it's a chargeable asset, to your child, your friend, whoever, you're going to give them that asset, that's treated as a disposal with capital gains tax. It's been the case for many, many years, but it does seem odd. You don't get anything for it. And out of the goodness of your heart, or the goodness of your planning, you want to give somebody something. It's treated something. If they're connected with you, and that will apply to most members of your family, then that's going to be treated as a sale and market value. So when you're thinking about lifetime giving, we'll get onto this in a little more detail in a minute, then you have to bear that in mind. Is this a chargeable asset for CGT? Cash isn't, main residence isn't, then it might give rise to a CGT liability. So what we're looking to do to save inheritance tax might actually trigger a CGT liability. Really important to keep all these moving parts in mind when thinking about a strategy. The good thing, often the best form of CGT planning is to die, not something you're going to factor into your planning. I know what I'll do. I'll die, that'll wipe out the CGT. But basically, all gains are wiped out on death, not economically, of course, but just from a CGT standpoint, you're zeroed, basically, and you go back to that you start for future gains at the value as at the date of death. So also something to bear in mind for those who are in later years thinking about planning and making lifetime gifts. If that gift is of an asset that has a large inbuilt gain to it, then you need to weigh up the difference between the potential inheritance tax saving against the very real, immediate CGT liability and the fact that actually that gets wiped out when I die. There's some broad principles of CGT. Inheritance tax, also no change going on there. The fundamentals are domicile is fundamentally important to liability. If you are not UK domiciled, then it's broadly speaking only going to be your UK assets that are subject to tax. Domicile was, of course, very much in the news a little earlier this year, and it raised people, God, I didn't know that was the case, that if you were non-domiciled, then you don't pay inheritance tax on your assets. So, yeah, all of that. So domicile is important. I'm sure most of you listening, probably watching, will be UK domiciled and resident, but that's something else you need to take advice on. For most inheritance tax are payable, the tax payable on death, the less taxable assets you own, said he, stating the obvious on death, the lower will be the inheritance tax and the greater the inheritance. Oh, that's worth thinking about. So if I give my assets away, then I won't have an inheritance tax problem. No, but most people have a problem with that because actually I do need something to live on. We'll get into that in a bit more detail in a minute. Overcoming that very real objection to giving away. The nil rate ban, basically the first chunk of your assets, not passing to your spouse because they're always exempt, 325,000, and the residence nil rate ban, 175,000, both transferable to the spouse if you don't use them or your civil partner during your lifetime. Then consider lifetime transfers, giving stuff away, as I mentioned earlier, definitely worth doing. But HMRC have introduced these rules that say, but if you give something away and continue to benefit from it, it doesn't count for inheritance tax. That seems pretty harsh. Yeah, revenue HMRC, as they're now called, introduced that to stop people so easily giving stuff away. Give it away, but it needs to be given away. Giving away means giving away and not continuing to benefit from it. There are some legitimate, tried and tested ways of overcoming that. HMRC accepted ways. Keep giving away my age by saying revenue. HMRC accepted ways of doing that, and Simon will be talking a bit more about that in the not too distant future. And the CGT point I've already mentioned. Subject to the above, forgive the pace. Use the reliefs and exemptions and the nil rates available to you. More on that in a sec. Make sure your will, really important in this whole thing, make sure your will reflects what you want to happen. Don't do your will, or first do a will, absolutely. Don't then do it and go, right, I've done that now, don't need to look at it again, because your feelings will change, your wealth will change, all of that will change. It needs to be reviewed. And of course, don't ignore something I'll mention at the end, the value of, we call it protection, you'll know it as life insurance. to create a legacy for the next generation or to pay the inheritance tax. As I said, a bit more on that in a minute. So pause and hand to Simon to just take you through those allowances, these really important allowances and exemptions in a bit more detail.
Thank you, Tony, and good afternoon, everyone. So the session Tony and I are going to do are going to be bit back and forth. So Tony's doing a bit and I am. Hopefully that'll keep it a bit more light, so you're not listening to one of us for a really extended period of time. I'm going to spend a bit of time looking at the tax allowances and tax exemptions, giving you an overview of them. And I'd encourage you to think about, for your own circumstances, are you aware of them? Are you using them? Is there anything that you need to do? Every time there's a budget, and Tony and I are involved in usually writing something about it, you always get a comment from the Office of Tax Simplification saying something along the lines of, the UK tax system is far too complicated and it needs to be simplified. And you know what? Broadly, they're right. So a big part of the advice that your partner gives to you is helping you navigate through that maze of taxation and make sure that where there's allowances and where there's exemptions, you do utilize them. Now, as we talk about these, it's really important to remember that they're not arbitrary. So what they're not are, oh, there's an allowance here, allowance there. Actually, I always like to think of them as how applicable are they to you. So if you think about your financial plan as just that, a financial plan, how do the allowances and how do the exemptions help you on that journey? How do they, how do you maximize returns through being tax efficient? How do you minimize tax drag? And for everyone that's listening, that'll be different. Some people might just want their income for retirement and that's it, nice and simple. Some people want to buy a holiday home in the Mediterranean. Some people want to help their kids do something. Some people might want to be philanthropic. There's many, many different ways. But really importantly is, let's take everything we're talking about and make sure that it's applied to you. Now, for an individual who is, we're going to assume UK resident and domiciled, you essentially get a standard no rate band, £325,000. You get a residence no rate band, which very broadly is one which can be set against the main residence, giving you £500,000 on average for most people of no rate band. And if you're a married couple or civil partners, that effectively you can aggregate that to create £1 million for most people. Now, the residence no rate band is really important because the government worded it very, very carefully to mean that there's lots of people that could miss out, and you can miss out even if, for example, your will isn't drafted appropriately to correct it. So it's really important that you look at things like your will, who's getting assets, and make sure that you're taking every allowance that's available to you. There are other allowances that require you to take action. Business relief, if you own a trading business or a business that qualifies, that gives you potentially unlimited inheritance tax relief on that asset. Likewise, if you've got a farm. And as Tony mentioned, a spousal exemption exists to mean that you can pass as much money as you like between spouses without there being inheritance tax. So the allowances are there to be used, or the bans or the exemptions. So really important to think about, am I using them? Are they in the right, am I doing them in the right way? On top of that, there's a number of gifting exemptions that are in existence that allow you to typically year in, year out, utilize them to further enhance your position. Let's look at the annual gifting exemption. Many of you will know that you can give £3,000 a year away and it's exempt from inheritance tax. And you're probably thinking, well, that doesn't sound much really, does it? But actually, where the real value comes is that aggregation, that consistency. If you and your spouse give away £3,000 a year, £6,000, if you do that for 10 years, you've given away £60,000. That's a potential inheritance tax saving of £24,000. So there's a tax aspect to it, but there's also a personal aspect that shouldn't be missed, which is you've then passed on £60,000 to the next generation. And generally speaking, that's going to make a big difference to people. Passing on that money would generally make a big difference. I always think there's a principle of kind of diminishing returns when it comes to finances, i.e. the more you've got, the less difference a given amount of money makes. You know, if you're starving and someone gives you £10, that's a huge amount of money. If you're a billionaire, someone gives you £10, it's kind of irrelevant. Now that's the two extremes, but in the middle, there's a, you know, somewhere between that is where everyone sits. And typically the subsequent generation who are a bit younger, perhaps starting out, perhaps got young families, perhaps, you know, in that walk of life, that's going to make a bigger difference. So trying to think broadly about tax saving, of course, but also how can I maximize my assets amongst my broad or extended family? How can I make the most of what I got? Where can I make the most difference? Within that, we'll talk a bit about control and protection, because, you know, the other side to that is how do you make sure gifts you make are properly looked after, remain in the family, are useful for where you want. And we're going to talk a little bit about trusts, but really important, allowances and exemptions, really important to make sure that they're utilised every year. So, Tony, back over to you.
Thanks, Simon. That's such a good point in relation to the, you know, the power of and the value in making lifetime gifts. And I think there's a donor and donee aspect to that, is that you actually then, as a donor, get the benefit of seeing the sort of the benefit that the donee gets out of that during your lifetime, rather than saving it all up to when you die and paying the IHT and then they have it. But the benefit in that, if you can do it, there's a non-financial benefit, which is really important, I think, for a lot of people. And when they've done it, most people do feel good about having done something good for their family. So that's a point that I'm sure anyone who's a parent or a grandparent will associate with. If it's possible, then most people would want to do that. So I don't want to dwell on this because it's a fairly simple little segue slide, really. Intergenerational financial success depends on being successful, I really think, in all of these three stages of that journey that Simon mentioned towards the successful passing on of as much as possible. And that is doing wealth creation, wealth preservation, and wealth transfer tax efficiently. It's if you do all of those things, if you're tax efficient in all of those stages, then the end result will be a good one, or better than it would be if you hadn't done those things. So the three pillars of financial planning, basically, I'll just have a quick look at, are these going to build? Yes, they are. Right, accumulation, building the money up, decumulation, taking the money out when you need it in whatever retirement means to you, and then preservation and transfer. So when you take your money out, doing it in a way that enables you to preserve as much as possible to pass on to the next generation, whilst allowing you to live your best life, so to speak. So living a tax efficient life means doing it all tax efficiently. Okay, probably didn't need this filler slide. You get the message from that. It's pretty much the same as the other with a picture. Right, tax smart accumulation to start with. Okay, I think there's general tax efficiency, and then there's very specific tax efficiency with relation in relation to intergenerational planning. First one, regular savings and lump sum investment. If you do them both tax efficiently, then you are self-evidently going to get a better outcome. The most important thing is having your money in the right place that accords with your attitude to risk, appetite for risk, all of that kind of stuff. That's really, really important. Getting the return at the right cost, also super important. Next bit is, of course, but doing it tax efficiently. You can do those two things well and then not bother about tax and end up worse off. So it's not the most important thing, but it is a strong contributor. And there's tax help in many places. Simon's referred to them. I've touched on them. You know, there's income tax allowances, there's CGT exemptions and reliefs, there's inheritance tax reliefs and exemptions to both navigate and make the use of. And of course, then there are tax incentivized investments that the government has said, we think it's a good thing for people to invest in these, and to encourage them to do that, we are going to give them tax incentives to do that. It's very obvious in relation to your pension, giving you a tax incentive to put money in, no tax on the money that's built up, no inheritance tax on the money that's taken out. It's all incredibly efficient, a big chunk of it coming out in tax-free cash. ISA, no front-end tax relief, but tax freedom from thereafter. Fantastic. And then more specialist venture capital trusts and enterprise investment schemes. So knowing that these exemptions exist, not slavishly doing all you can to make use of them, but if it fits with your life goals, making use of them does absolutely make sense. It's money that is available legitimately for you to have or save. Why not make use of them? There's on investment in that accumulation stage, just if you're looking at maximizing the allowances that you've got and exemptions that you've got, to make sure that what builds up for you in that accumulation is the best for you, then think about using your personal allowance, obviously. Think about the dividend allowance. You can make up to £2,000 of dividends every year completely free of tax. That would equate to a 3% yield on a portfolio of a £60,000 investment. So for a couple, that's 120,000 on top of their ISAs after the pensions and ISAs. Once you've done that, another 60,000 each would probably generate a tax-free return, no tax on the dividends, and then with proper management and advice, also using the CGT exemption. And that CGT exemption, 12,300 every year. If you can use that every year by disinvesting and reinvesting in the right way, not triggering anti-avoidance provisions, doing it cost efficiently, that can keep up rating the base value, so-called base value of your investment. So when you finally come to cash it in, you have a much, much smaller chargeable gain because along the way, you've used your £12,300 exemption. If you've got any interest, you could generate up to the right sort of individual. As Simon said, it all depends on your particular situation, up to £6,000 tax-free. And with interest rates going up, that becomes a little bit more, important. Then before we get to the specific opportunities, there are also opportunities that are sometimes forgotten and your partner will be able to tell you more about these. Once you get beyond your pensions and your ISAs, doing this kind of tax hierarchy, pensions, ISAs, dividend allowance with investments in collective investments and direct equities, etc., then there's a real power in investment bonds. They're insurance-based investments that shelter you from tax as they go along and give you the opportunity for very long-standing tax efficiencies when you take them out. I say very long-standing because the legislation around these opportunities has been with us since 1968 in one case, 1975 is in another. So this isn't newfangled stuff. It's stuff that's been with us for a long while. As I said, if that's something that interests you, you should definitely speak to your partner about that. And then there are very specific ways for you to invest for the next generation. So I'm going to hand back to Simon now to take you through those specific ways, really, really powerful ways. And a couple of the ways I've taken on myself for my grandchildren. So I'm either an idiot or, it was a good thing to do.
Thanks, Tony. Well, if you are an idiot, I'm as well, because I have some of these for my children as well. So yes, tax efficient for regular and capital investment. As you can probably imagine, there are endless potential things you could look at doing. And a big opportunity is using a junior ISA. A junior ISA is just like a regular ISA in that it's broadly free of income tax, capital gains tax, but rather than being for an adult, as the name suggests, it's for a child. So it's a way of really, really tax efficiently building up money for the next generation, trying to help with that question that we all ask. I've certainly asked it about my kids. I'm sure Tony's asked it about his grandkids, which is, how are they going to get on the property ladder? What's university going to cost? What's life going to look like for them? Is it going to be more challenging? Possibly. Is it going to be more expensive? Probably. What's it going to look like? And the second part of that question, which is, what could I do to support them? Junior ISA, really efficient piece of planning. The parent or guardian needs to set it up, and you can put in up to £9,000 a year, which can be put in by anyone. So the parent could set it up, the grandparent, the uncle, or whatever it might be, can make the contribution. So a really, really effective way. And then when the child reaches 18, that becomes a standard ISA, and it's theirs to utilize as they wish. So very, very tax efficient. And your payment into that ISA would either be would most likely to be a gift for inheritance tax, and therefore, if you meet the survivorship period, typically 7 years, you'll save inheritance tax as well. So you're kind of getting a double, a double tax break for doing so. Really, really efficient and really, really powerful planning. Now, what it also gives you is the opportunity to benefit from compound interest. Compound interest is what Albert Einstein described as the eighth wonder of the world. He said, those that understand it earn it, those that don't pay it. So just to give you an example, if you invested £9,000 a year for 18 years and it grew at 3% per annum, the compound interest would mean that at the end that would be worth somewhere around 226,000. Now that's at 3%. It might grow less, it might grow more. That's a fairly conservative growth rate. And of course, You don't have to use all of the £9,000 ISA allowance. You could invest, say, £2,000 over 18 years. That would create a significant tax-free sum that could be used for, whatever they wish, university costs, or, for example, purchasing a property. So from a tax perspective, it's really attractive, and lots of people do take that on. But the downside to it is, for some clients' perspective, is that at 18, that money is absolutely theirs. So they can spend it all on whatever they wish. So you could be sending your 18-year-old to Freshers Week with £226,000 in their back pocket. Maybe you'd like to do that. Maybe you think that's a good idea. They probably would, but maybe that's not for everyone. So balancing that tax benefit with something which is quite important, which is control and protection. How can we make sure that funds which we pass in an efficient way are also controlled and protected? And there are a number of ways to do that. Potentially looking at unit trusts held in a trust, created through a regular lump sum investment, using potentially the child's CGT exemption, passing on control to them at a later date. There's lots of planning that you can do using trusts, and we'll look at trusts in a little bit more detail as we go through. But lots of things that can be done to protect some of those monies. And potentially as well, you could look at bonds or international bonds in a trust, and then when the beneficiary becomes an adult, you can assign parts to them to utilize their allowances and their exemptions. International bonds, Tony's going to touch on them in a moment, but broadly don't pay any tax within the fund. So you've had a gross return, and then you can carefully assign them to a beneficiary when they get to 18, small parts at a time, to utilize all of their allowances and all their exemptions. Again, to kind of double up on tax reliefs. You've got inheritance tax relief through your gift. You've had the control and protection with trust, and you've assigned out of the trust to an adult beneficiary, potentially with no income, for example, university, and utilize their allowances and their exemptions. So all in all, a really, really tax efficient way to pass money out of your estate into a trust, and with everything that comes with a trust, and then assigning out at the end to utilize their allowances and their exemptions. The other thing which sometimes causes people to scratch their heads a little bit is, did you know you can set up a pension for a newborn baby? Did you know a newborn baby could have a pension? And thinking about Albert Einstein and compound growth and long-term investments, what better way to make an investment that your child can't touch or grandchild can't touch until they're 65, or slightly more than that now, in fact, potentially. So when your child's born, if you put in £2,880 into their pension on day one, day of birth, I'm sure you go visit them first, but let's assume the first thing you do is pop the money into a pension for them. That's topped up by the government to £3,600. If that grew at 5.5% per annum, by the time they got to 65, that £2,880 would be worth £127,000 or thereabouts. That's the power of long-term growth. Now imagine you did that for 2 years or 3 years or 5 years. You could really make a difference. They can get on with their life thinking, actually, because of what my grandparents did when I was a baby, actually that's broadly going to fund my pension for retirement. Do you know what? I don't need to worry about that. I've got money to spend on other things. A really, really effective piece of planning around compound interest and tax efficiency. So Tony, back over to you, and Tony's going to run through decumulation, which for me is the biggest value that we can add. Decumulation, doing that in a really efficient way, is hugely important. So Tony, back over to you.
Thank you. This is like a relay race, and Simon's always running the good legs, and then I come on and we lag behind again, and he has to sort of catch up. So well done. Thanks, Simon. Yeah, taking decumulation, what a rubbish word invented by the financial sector, but it basically means taking money out of what you've built up. So continuing that theme of doing it tax efficiently, then it's really important to achieve that end goal of passing on as much as possible to the next generation. So when you're taking money out, to think about taxation and go, actually, I should leave money in a place where it's most tax efficient, and I should take money from a place where it's most tax efficient to take it from. And that's basically the rule. Because we all have and this is great, a lot more choice than we used to have. And most of us who are fortunate enough, basically, will have a range of assets, either by accident or design. When the time comes to say, actually, I'm going to work a bit less, and so I need a bit more drawing from my financial capital to supplement my human capital, or the rewards from human capital, which is basically working, or I'm just going to flat out retire in an old school kind of way, and I need to take my money. The natural place to go, oh, my pension, that's what I did it for. But that would probably be, from a pure tax and long-term intergenerational success standpoint, the worst place to take your money from. Think about taking it from other places. Why is that then? Because the pension, whilst it remains in the investments while they remain in the pension fund, can continue to generate tax-free income and capital gains inside the fund. When you die, the pension is completely free of inheritance tax, and it can be left to the next generation or into a trust fund. So why would you want to diminish that, rethink the pension, and take money from somewhere else? Where else then? Well, if you took money from an ISA, plus there's the point that the pension, after the tax-free cash bit, is taxable. So to achieve a certain amount of money to spend, you'd have to draw down from the pension enough to both give you the spending money and pay the tax on it. So if you could take money from a place that wasn't so tax efficient, but wasn't also taxable, and you go, oh, that's a nicer, that is subject to inheritance tax, but the money I take out is completely tax-free. And you go, yeah, but the underlying fund, that's completely tax-free. Yeah, how about taking it from somewhere else, using the tax efficiencies that exist in the legislation, from collectives or bonds, which are not as tax efficient of themselves, or the underlying funds are not, unless you use a trust, free of inheritance tax. You can see here, but the amount coming out could still be tax efficient. That will be the best thing, to leave the pension and ISA on tax and take the money from somewhere else. Yeah, possibly. So you can, that's just some of the moving parts. The main residence, for example, you know, it is possible. It's probably not right for most people, but you could, some people would consider, how about if I took a loan on my main residence, a kind of equity release, and use that to do the IHT planning, or to replace my pension. And then I've got a debt on my estate. Loads of moving parts there. Absolutely not right for everybody. Could be right for some. It's where you absolutely need the value of advice, excuse me, advisors who know their stuff and can take all of these into account to build, to Simon's point, the plan that is right for you, because everyone's situation, both in relation to the assets they own and what's important to them, will be different. That decumulation bit is important, because if, as a result of all of that, you get the life you want in whatever retirement means to you, but the amount that's left, because of the planning, because of that tax minimization, is the greatest number, basically. That's got to be worth doing, absolutely got to. And as Simon said, it's an area that St James's Place are spending a lot of time, excuse me, particularly throat. Right. So best practice, which I've already mentioned, so I don't need to go over that. Actually, be very careful, because there is that point of, actually what you want in retirement is money. It doesn't have to necessarily be natural income. It might be worth drawing down from capital to use the tax efficiencies that are available to you, the annual exemption from CGT, for example. But bear in mind, if you're drawing down from capital at a time when, like now, asset values are lower than they have been in the past, it may be that the capital you draw, the amount you need to draw from your capital to give you that net sum, albeit tax efficiently, will diminish the capital greater effectively for the long run, because you've taken money out at a time when the values were lower than they have been. And that's called sequencing risk, basically, or pound cost ravaging. Don't need to know that really. I know why I even mentioned it. But basically, just be careful if you're drawing down on capital. Definitely consider it, but with advice, be careful about it. Maintain funds in tax-favored locations, minimize the tax on what you draw. They're the key determinants. And saying it in a slightly different way, here we are, the tax rules of tax smart drawdown. Tax efficiently draw from the least tax efficient funds first, draw from funds that in a way facilitates the greatest chance of preserving the value of the capital, preserve funds in an IHT attractive location, like a pension, and definitely because there are this may seem self-serving, but it's absolutely the case. There are so many moving parts with so many intricacies attached to those moving parts, absolutely seek advice. This is something which St James's Place has spent an awful lot of time on, will continue to spend time on, and your partner will be able to talk you through without any doubt. And as I said, perhaps just as a starting point, just change how you think. Don't be so prescriptive forgive me if that also sounds patronizing, about how you think about your pensions. The name's a bit misleading with pensions. It can be just an intergenerational trust fund. That's what it might end up being for those who are lucky enough to have a range of other assets that they could draw on rather than this when the time comes. So continuing on that delivering tax alpha, the final bit of that, we've looked only in a very sort of almost superficial way at the accumulation stage, the decumulation stage, and things you can do to make sure that when you get to this stage, you've got as much as possible to be passed on. But at this point, then you need to consider the tax that applies at that point. So here's just a little reference to one of my all-time favorite bands, The Who. I find there's quite a good irony in this. Is you might, some of you, the older ones of you might remember, although it's a standard song, written in 1965, My Generation. It's quite funny that the composer and the singer of those songs, Pete Townsend and Roger Daltrey, respectively, are now 77 and 78. So one of the lines in there you might remember is, hope I die before I get old. Well, we are all living longer. Pete and Roger are definitely examples of that. Not so much Keith Moon and John Entwistle. Anyway, moving on from that little personal diversion. I've got to get songs out of my head now. Right, minimizing inheritance tax will, statement of the obvious, help you to achieve intergenerational objectives, because that is where most people start. That's why I think it was really important that we dealt with that accumulation, decumulation, because you haven't done that well, you will definitely have less at the point where it comes, oh, now I've got to think about inheritance tax, which, by the way, from the latest YouGov survey, admittedly a few years ago now, but last time they asked, this was the most hated tax or the most disliked of all the personal taxes was inheritance tax. You know, it's that kind of, well, I've worked all my life, paid my taxes, and now you're going to take up to 40%. Well, 40% once you get over the exemptions. Yep, that's how it works. So people are keen, and I'm sure you are, to do what you can to avoid it in a way that fits with your life as well. So some standard rules here: make sure your will reflects what you want to happen. I've said that before, as tax efficiently as possible. For most, inheritance tax is a tax payable on death, yes, or second death, where couples usually leave most to each other. Remember the nil rate there, and Simon's already mentioned that. The lower the value of the estate, statement of the obvious on death, the lower will be the inheritance tax. So consider lifetime transfers and investing in things when it fits for the rest of your life, really, that qualify for relief. But mostly think about lifetime transfers. When you're thinking about those, though, there are well, there are a number, not more than two, but main ones, impediments to giving. From a taxpayer standpoint, from your standpoint, there is, yeah, I see the value from an inheritance tax standpoint in giving away, because then I've got less on death and then the inheritance tax is less. But I'm a bit worried about not having control over what if the person I give it to ends up not being the person I would have wanted giving it to. I want a bit more control over when and how, or I don't want to give it just yet, but I would want to get it out of my estate. Or actually, I need to have access to that money as well in the meantime. And then there's legislative impediments, that gift with reservation, pre-owned assets tax, basically together say, if you want to give stuff away, then you can no longer benefit from it. That's the general, if you want it to work for inheritance tax. Now, to see the impact of that, you need to consider all of your assets. So in a very brief way, and we've had a few on the pre-submitted questions. Anyway, we've had a number of questions about giving away your main residence. You know, can I sign it over to my children but carry on living there? Is it all right if I put the assets, the house, in the name of my kids? Then the answer is you can do it from a legal standpoint. You can think about it from a personal standpoint. From an inheritance tax standpoint, if you give the home, your main residence, away and continue to live in it, and either don't pay a full market rent for it, so you can give it away and pay a full market rent, then you're not enjoying a benefit because you're paying for it. That works for some people who are asset rich in the shape of their main residence and cash rich in that they can pay rent, which then isn't a transfer for inheritance tax, but it is moving money out of their estate, which is taxable on the receiver. Stop, we could go on. Basically, so giving your home away is difficult unless you're going to pay a full market rent or give a share in your home away and then jointly occupy it. That was a specific question from someone. Could I give the house to my part of the interest in my home to my child who then lives in the house with me? Yeah, you absolutely can. And all of these things you can absolutely do. But that would also work for inheritance tax because it's seen that you are not enjoying the same level of benefit, so don't trigger the legislation. And that's all absolutely clear. It's not some sort of fancy interpretation, some tax avoidance. It's absolutely not. The legislation says you can do that. So pay full market rent or jointly occupy, having given away a share in the house. Otherwise, generally doesn't work to give your home away from an inheritance tax standpoint. And for a lot of people, they don't feel comfortable doing it anyway. Equity release is another possible way to use your home to facilitate planning, but again, not really right for most people. Can be right for some. For your second property, it's a little easier because it's a holiday home. You could go, actually, I'm just going to pay for the time when I go there, but I move it out of my estate. I can give it to the next generation. Another question that was asked, and I'll just pay for when I go there, because I don't go there loads now, and it'll be good for the family to use it, so I might as well get it out of my estate now. Bear in mind when you move it out of the estate that will trigger, because it's not an exempt asset, a possible capital gains tax liability, unless we get into some more planning. So basically, that's something to bear in mind. You don't need to worry about your pension, because that's inheritance tax free. You don't need to worry about your business in most cases, because that'll be inheritance tax free in most cases, because of business relief. So when it comes to your cash and investments, there are very clear ways that are effectively allowed within the legislation for you to plan and still receive a form of benefit. And the facilitator for that is a trust in most cases. And there's no one better, in my opinion, to talk to you about those arrangements, the way in which a trust can work with cash and investments, than Simon. So.
There we are. Apologies, I had a little bit of a challenge to get my video back on. Yeah, so trusts, trust at its simplest level are a way of holding an asset for the benefit of somebody else. So the way to hold an asset, and so I'm giving it away to the trust, but the beneficiaries are usually part of a group, but they don't have any entitlement to it. So you can make the gift, but it's controlled and protected. So it works really, really well. Big part of financial planning, a big part of what we do. But the question that Tony raised, or the point Tony raised a little bit earlier, was actually a really good one. Sorry, I shouldn't sound surprised. Was a good one. And if you give money away, what if you need it? If you give money away, we have this conversation a lot. I'd like to give money away. I take your point about leaving my pension alone, but can I make a gift and still get some income? The answer to that is yes. So we've got a trust called a discounted gift plan, where you can make a gift into that trust. Absolutely no problem at all. That trust, that money is invested within the trust, typically using an investment bond, and that pays you a fixed income for life or until the fund is exhausted. We tend to restrict it to 4%, so it'd have to go for a lot of years before all that money was back, and the risk of exhaustion is going to be pretty low. But the idea being, if the fund grew at 4%, you took 4%, the value would remain broadly static, but you've made a gift. So you've gifted that sum. So after 7 years, it's outside of your estate, but you can retain that income for life. Really, really attractive. If that might be of interest to you, if income is a big factor in your planning, speak to your partner. The other way we can look at that is, rather than gifting to a trust, you could loan to a trust. So you could make a gift to a trust. Again, that loan is made to the trustees. They invest that typically within an investment bond. Sorry, so it just pops up with investment bond. And you've got the ability to recall your loan either as an ongoing income stream in ad hoc points, or never at all in your lifetime. Either one is absolutely fine. The question is, of course, again, a fair one. Well, why would you bother loan? Really, a loan to trust is done because you want to keep the growth of your assets outside of your estate. The growth in that asset is effectively being given to a trust. So you loan £100,000. After 10 years, it's worth £150,000, for example. That £50,000 growth, as you can see in the example on screen, is held on trust for the next generation. So it stops your assets getting any bigger for inheritance tax planning. So it's quite a light touch piece of inheritance tax planning that keeps growth out of your estate. And going back to Tony's initial point right at the start, with allowances and exemptions being fixed for it was 5 years at the time, till 2026. That means the standard nil rate band has been 325,000 between 2009 and 2026. Really, really long time. So that keeping that growth outside your estate is really important. And really thinking about this early is important, because you've got the outstanding loan that you can draw back. And if you were to recall that loan over time, obviously the growth would be different because you're drawing money from it. But if you were to recall that loan over time, gradually that loan, i.e. the bit inside your inheritance tax estate, would gradually reduce until it got down to nil as the loan repaid. Other planning ideas and opportunities. Business relief. You can have investments which qualify for business relief. Really straightforward. In the most straightforward way I can explain it, it qualifies as a trading business, and there's no inheritance tax to pay once you've owned it for 2 years. So it is a high risk investment. It's absolutely not for everyone. But if you are looking at gifting, thinking, I just don't know, I've got 7 years in me, or you're looking at a family member and saying, do you know what, they're 88 now, I just don't know if they've got seven years in them. Actually, business relief for the right client, it's not for everyone, speak to your partner, but for the right client, it's really attractive. The asset is still held by you, so you've not gifted it, you're still owning it, it's still in your name, so you can still draw on it should you wish, but the value is nil for inheritance tax. So it's quite a nice way, if you need to get money out of your estate quite quickly, it's a really, really attractive proposition. And then the final bit is around protection and using protection to cover that. I'm going to pass back to Tony, who's going to cover the last section.
Thanks, Simon, for getting there. Thanks for that very much. I love that bit about, surprisingly, that was quite a good answer. That's great. So anyway, yes, protection, life insurance. This also goes to a question that was asked around, is it worth doing inheritance tax, life insurance, or words to that effect? And the answer is, it could be, it can be. It all depends on the cost of it, basically, against the benefit. I mean, if you're not in great health or you're very old, then it probably isn't. It depends on your circumstances. So I would say, in principle, in many cases, it can be a tremendously effective way of planning once you've considered seriously and carefully all of the other ways that we've just talked about. Giving assets away, using trust, investing in business relief investments. And I would say for some of that, we found in most cases that a combination of solutions works rather than a kind of all-on-one answer. So a combination of a loan trust, a discounted gift trust, an ordinary gift, and then maybe for the investments that are left that you can't give away, or the assets that are left that you can't give away, and the liability is there, and you still would like to do something about it, then life insurance can be a simple way to pay for the inheritance tax and make sure that your family receives the full benefit of your estate at that point. It's a very, very simple method, because basically, and it works so well within the tax regime, because the gift is treated as made when you pay the premium, which is relatively small, hugely small, actually, hugely small. No, that's not the right, relatively small compared to the sum insured that's eventually paid out. So the gift is made when you paid the premium, and there are exemptions in place, in particular, the normal expenditure out of income exemption. That means in almost every case, that premium is going to be exempt. Then when the sum assured is paid out, because that policy is in trust for you, the persons or persons you want to get the money who will pay the inheritance tax, then the gift has already been made when you made the premium. So when those hundreds of thousands come out of the life insurance, then the gift has already been made when you made the small amounts in which were exempt. So it works really, really well. It could also be a way of, actually, I didn't do as well as I could have during my lifetime. I'd like to create a legacy for my family, or enhance, supercharge the legacy, which they won't get until I die. Life insurance is another way of doing that. As I said, it all depends on your circumstances. Partner will be very well able to help you with that. And I think generally on that whole point of life insurance, without banging on too much about that, I think it's a case that we've all got so preoccupied, understandably, with wealth creation and how do I take my money out and what's my pension worth and what's the market doing today, that we've perhaps forgotten maybe one of the most important aspects of our financial plan is to making sure that in the case of a disaster, basically our death or our serious illness, that our family are sufficiently financially protected. And I think I've got my own ideas around this. I think it's because, maybe this changed a bit during the pandemic, is that we often deal with, you can see my little arrow, we deal with things that are very important and very urgent, quite rightly, because that's what we do. But unfortunately, because of the amount of stuff we get in to deal with, we also probably prioritize stuff that is seen as urgent, very urgent, but it's actually not that important. But because it comes into our inbox, we tend to deal with it, as it were, our inbox of life, basically. Things that clearly something is not important and not urgent, then we definitely need to put that in box 4 and not deal with it till we've got any sort of time. But this is the box number 2, which is the dangerous one. That is very, very important, but not urgent. Not seen as urgent. No, I feel okay today. Yeah, feeling good. I'm not going to die anytime soon. So you don't feel ill. I'm not going to get seriously ill. You don't deal with it. But when that happens and you haven't dealt with it, it's a really big thing. Sorry for that sort of, chastising, chiding approach to that. But I think it's something we all need to think about in a bit more detail, the what if situation. And I think we owe it to ourselves and our family to do that. So, and all of those things, your partner will definitely be able to help you with. So the next steps, right. First, carefully think about your immediate and longer term aspirations for the next generation, your family and dependent. Definitely apply that thinking to the entirety of your financial journey. Take account of all of your assets in planning. Definitely everything. It's not just about the cash and investments. And we can definitely help you with all of that. Subject to personal and economic considerations, maximize those tax efficiencies. It can make a huge difference if you do stuff tax efficiently. Says me as the supposed expert, do stuff tax efficiently. And then seek advice. There's a lot going on in all of this. There's loads of moving parts. It is complex. Spending the time with an expert to help you get it right will definitely pay off. It will have definitely, in our opinion, in fact, we know it will deliver that all-important advice alpha. So we've got to that point within time, amazingly, in my opinion, all thanks to Simon, really. And I'm going to hand to Richard, but stay here. And Simon, I was going to invite him back, but he's already there, to see if we're going to have a few questions.
Thanks, Tony, and thanks, Simon, as well, for those really, really informative sessions. We haven't got a lot of time left, so I've just picked out a couple of questions that have been asked quite a bit. I also lost a bit of connection actually partway through, so hopefully you didn't cover this. If you did, we'll move on to the next one. But there's been quite a few questions about the resident nil rate band. In particular, there's one that said, to benefit, do I specifically have to bequest the residence to my offspring? Who would like to take that one?
Shall I take that one?
Yeah.
So the residence nil rate band comes with a couple of caveats. Number one, once your estate is above 2 million, it starts to be abated. His favourite 2 for 1. So every £2 of asset you've got over 2 million, you lose £1 your residence nil rate band. The other bit, which is important, which is I noticed put in a couple of questions, which is, do I have to give it to my offspring? You have to give it to a direct descendant. So direct descendant in this point is fairly broad. So it includes children, includes grandchildren, great-grandchildren, it includes stepchildren, it includes adopted children, anyone who is a direct descendant of yours. What's most important is that it doesn't include a discretionary trust. So keep an eye on your will, make sure your property goes to a direct descendant if you want to claim that allowance. And it's back to the point around wills, making sure your will is structured in such a way. If you haven't updated it since 2017, then that's kind of the date you probably want to just get someone to have a quick look over it and say, will this cause me any issues with the residential nil rate band? Because for a couple, it's £350,000 of relief. 40% of that would be lost if you've got your will done incorrectly, which will make a obviously material difference to your offspring's receipt of funds.
Thanks, Simon. And just to kind of follow on what Tony said, I mean, please pick up the phone if there's anything specifically relevant to your own personal circumstances that you feel you need to have a conversation. Then it goes without saying that pick up your phone to your St James's Place partner, and I'm sure they'll be happy to help. Reasonably generic one here, probably one for you, I would think, Tony, which is when is a good time to start this planning? Is there an age? Is there a particular age, set of circumstances? What would be your view on the right time to start?
Yeah, that's a super generic one. I think the key point is, I think it's never too early if it's right for you. As I was at pains to say throughout that, this isn't about just planning at the end to minimise inheritance tax. It is doing the best you can during the accumulation period and the decumulation period to end up with the greatest sum that is available to you, having had a good life yourself, to leave to the next generation. So no time's too early. I mean, clearly, you're not going to people who are in their teens are not really going to be thinking about intergenerational planning for their next generation. They might well be thinking upwards, of course. It's another thing, you know, in terms of who's going to be getting the money. And having those awkward conversations. But I think, no, it's never too early to consider it, but it is, as Simon had mentioned as well, it's a very subjective, personal thing. So I would just say, if you say, actually, it's something I would like to start that conversation about, then speak to your partner, and I know they will do all they can to help you with that.
Thanks, Tony. Another tricky one. I've had a question around, how do you see potential changes to the inheritance tax rules moving forward? I think the question is in the next 20 years. And it actually, the question was also, there's another question that said, how much have the rules changed over the past 20 years? So there's a kind of look back and look forward.
Yeah, okay. No, I'm happy to do that. Yeah, I touched on the fact that there were some very formal proposals by the Office of Tax Simplification, who had been asked by Philip Hammond, remember him, when he was Chancellor, to review inheritance tax. It didn't end up with anything that was very sort of tax changing, but there were some changes that, you know, getting rid of the rule where you had to possibly look back 14 years, turning 7-year accumulation into 5-year accumulation, some things that were genuinely okay, I think, around to clean up the inheritance tax. But they were all shelved. I think everything else that the HMRC and the Treasury have to deal with, just said, look, we don't need this now, we'll just leave that stable. So I would say on the look forward piece, and 20 years is far too long to predict anything. 20 days is too much these days, I think. But I think for this government, given what they'd said, whilst we have this government, then no further change. If we had a change of government, if we had a Labour government, I'd say it would be almost certain that there would be some change to capital taxation, both capital gains tax and inheritance tax. That's no great insight for me. I think that's pretty obvious, given that, you know, that we're maybe not as quite as stark as a Jeremy Corbyn, John McDonnell versus, you know, the Tory government. But basically, I think you'd see, yeah, if there was a change of government, you could expect to see a change. If there wasn't, then maybe no major change. There's been a lot of push for wealth tax, for example, as a kind of COVID recovery tax. Here's a way to repay government debt. Why don't we apply a wealth tax? And there was a wealth tax commission established, not by the government, but to review this in great depth. Nothing's happened as a result of that. Both the current Chancellor and the Prime Minister have said this is not something a Conservative government is going to be doing, wealth tax, and we don't think it works. There's not many countries in Europe that actually have one either. So going forward, who knows, 20 years, for the foreseeable future, with this government, next couple of years, no change. Labour government, almost certainly change. Looking back 20 years, then the biggest change that happens when we got capital transfer tax turning into inheritance tax. And that was more than 20 years ago. We've had relative stability. There are changes along the way, but it's been more incremental as opposed to, you know, life-shattering, really. So relative stability, actually, over the last few years.
Thank you, Tony. A more specific question, you'll be pleased to know. I had a question said, we have recently given my son, 18,000 for house and wedding help. How should that gift be recorded?
I can do it.
Yeah, do you want me to that? I would just say, you know, obviously just, you know, keep a record of it when you did it, that it was a gift and not a loan. And also worth thinking about the allowances that you can set against it. So you might have 2 lots of £3,000 annual exemption to offset against it if it was made by a couple, giving you 12,000 of it, plus potentially a wedding gift could be as much as 5. Maybe the vast majority of that gift actually is covered by your exemptions. And it's just worth noting, you know, should your executors ever need to prove when the gift was made and it was a gift, then, you know, just as robust an audit trail as you have, perhaps a note to them to say, I gave you this money and this is, you know, this was the date. So I don't know if you've got anything to add to that, Tony.
No, I think that's a great answer. I mean, basically, yeah, as Simon has clearly said, that there's no formal requirement to the HMRC. You can tell them and they'll just say, I don't want to know this, because you don't have to report lifetime gifts unless it's a charge. If you've got a chargeable lifetime transfer, that's only, other than an outright gift, effectively. It gets a little more detailed than that, but then you don't have to, and even that, you've got the first 325,000 of nil rate band to use. And then there's that other point from a pure tax standpoint, even as Simon mentioned, but you won't have to even consider it. Once you've survived the gift by 7 years, it's just wiped off the slate. That's the thing about planning, is that if you're thinking of doing this and getting into a regime of actually want to start doing something about inheritance tax, and to your earlier question, I should have said this, generally speaking, the earlier you start, the better, because if you get something outside of your estate, you've not only got that asset up, but you've avoided the increasing growth in that asset remaining in your estate, assuming it did increase in growth. So I think overall, yeah, good answer. That's it. Don't need to record anything. Don't need to report anything unless it's a chargeable lifetime transfer. For most people, they don't make chargeable lifetime transfers if it's going to trigger a lifetime tax payable right now. Probably that's what we've established. That's what we've experienced anyway.
Thanks, guys. I've heard this one asked a lot actually in my travels. Do you think there's any risk that they will abolish the tax-free cash from pensions?
We've probably both got the same view. And I would say, I mean, there's always, with tax, you never know what's going to happen. And because pensions tax relief generally always seems to get raised up every time there's a government need for cash, and it costs apparently nearly 40 billion a year to give all of the reliefs. And they go, well, you could take it away from tax-free cash. But the fact that it's going to be so difficult to do that, I think, and there's so much involved, there's so much complexity in that. And then you've got all of the public sector having the rights to tax-free cash, and you'll see what happens when you try to change anything in relation to the public sector. I think you couldn't say there is absolutely no risk, but I think there's very, very little risk. There's also the political point of going, that affects, this is not something that is, oh, it's just those rich people. Anyone who's in a pension scheme, having been able to take out that roughly 25%, the tax-free cash, is important. So you are going to annoy a big part of the voting population if you take it away, which sounds very cynical, but it's not something that any government is going to think, really lightly about, really, before changing. Yeah.
Okay, guys, it's what is it, 17:38. Time for one more, I think, probably. And as we said earlier on, we will make sure that we find a way of answering the questions we haven't been able to answer today. Fairly long question, this one. And it goes like this: I will see a significant tax hit on my pension when I get to age 75. Then I die one day after my 75th birthday, and my kids are 40% taxpayers. They will take a hit. Is pension a good place to mitigate tax? Isn't it similar to IHT levels?
Well, I'd say that's a very, very good question. The answer to which is there are so many factors at play here. So you're right. Potentially, if you get to 75, if you've exceeded the lifetime allowance, you'll have a lifetime allowance tax charge paid for by the fund. What's really important to remember is, I always like to think of it as, how much money has this pension actually cost me in real terms? Most people have had an employer who's contributed. You would have had tax relief. You would have had probably decades of tax-free growth. So, there's lots of thinking about there. So even if there is a charge at 75, which, you can have just over £1 million before that's the case, and then you die, it's still free of inheritance tax. And what you're talking about post 75 is if your next generation draw from the pension. So let's say I'm 76, I die, and then my pension goes to my kids. I can pass it to them in the form of a pension, and there's no immediate tax. There's only a tax if they draw on that pension. The beauty of the pension drawdown means that they can manage that income. So they can say, I'm retiring in 10 years, I'm going to leave it there in a great tax-free environment until I retire. So tax mitigation with pensions is a fascinating subject. We could talk about that for a long, long time. But in spite of that, you've still got £1 million, which is IHT exempt, and you can manage that tax position for the next generation going forward. And finally, also really important to remember is, if you retain a pension on death, no further lifetime allowance charges. So let's assume your children get it, they're not going to be assessed for lifetime allowance on the inherited pension. So it could continue to grow lifetime allowance tax-free. And that this is a massively complicated subject. We could have done a whole webinar on this. Fortunately, we haven't. But yeah, I still think for most people, for the most part, pensions are probably the most tax efficient means of holding money for most people. Again, I don't know if you've got anything to add to that.
I absolutely agree. I think to make a comparison, you could, if you're starting from ground zero from the start, go, where should I put my money? Because you're going to do something else if you aren't going to do the pension, and map that against different scenarios. I think despite the fact that when you've got that potential for a lifetime allowance charge, which will only apply if your fund is over that lifetime allowance. And for those that aren't, then the managing of the outcome and the vast amount of extra, that point of intergenerational success comes from all three stages: accumulation, decumulation, and the passing on. Then the pension scores at all of those levels and has the potential for that extra charge at the end. But then you're always going to have that extra charge at the end with your assets. And I would say whatever scenario you probably plan for, that you're probably going to see, because of that, taking that whole life of view, that you're going to see the pension will score with. Ideally, we like to have, there's no tax on anything at any point at any time. But given that you can't have that, then I think it's going to give you as good an outcome as you possibly could get compared to other choices.
Brilliant. What a great way to end, I think, guys. Tony, Simon, thank you very much to our clients and guests. Thank you very much for joining the webinar today. As I say, on behalf of your St James Place partners, thank you for joining. We hope you found it informative. There should be some feedback pop up immediately you sign off from the meeting. But in the meantime, thank you for joining, and we will see you again at a future event. Thank you very much indeed.
Cheers.